What is going on, my friends? It's great to see you guys. My name is Ryan Williams, and in today's video, we are going to be talking about the best dividend stocks to buy in August of 2021. Now today, guys, we are going to be covering 4 different dividend paying companies. And just so you guys know my criteria, I chose these 4 stocks based on how they're currently valued, how they've been performing in the last month, and also because of their dividend stats, which absolutely is something we are going to go in depth on. And just so you guys are aware, I do currently own 2 of the 4 companies we're going to be talking about today. And then the other 2 are actually sitting on my watch list. I'm still chewing on the idea of buying into them, just not 100% sure yet. Anyway, before we get rocking and rolling, if you guys are stoked to learn about some dividend stocks today, please go ahead and give this video a big thumbs up. And if you're interested in seeing more videos from me in the future, please go ahead and subscribe as well so you can join me on my dividend stock investing journey. I would love to have you along for the ride. Anyway, thank you guys so much for doing that. I really appreciate it. And now, without further ado, let's get into it. All right, guys, now to kick things off, we are going to be talking about a company that you guys hear me mention all the time, especially in these monthly videos where we talk about which stocks to buy, and that is Campbell Soup Company, ticker symbol CPB. Now, as far as its performance goes, in the last 5 years, Campbell's is down 30%, a whopping 30%. It's at a very steep discount. Just in the last year, it's down about a third of that, about 10.3%, which is unreal. This is a huge decline from last year's price, 10%, guys. In the last 6 months, it's down about 5%. And just in the last 30 days, just in the last month, it's down about 3%. So it's even more of a discount now than it was last month. And looking right over here, guys, another indicator of Campbell's affordability is its forward PE ratio, which is currently sitting at 15.2, which is extremely low. And going back to the performance, as we can see, guys, it's really, the momentum with this company is not great. It just seems to keep going down and down in price. My current position is down, I'd say, about 4%, but I do believe the future is bright for this company. If we go over to this growth page right here, guys, and scroll down a little bit to this revenue row right here, we can see that it's actually still growing in revenue every year. Just year over year, it's up 4% in revenue. Just in the last 3 years, it's up 5.5% in revenue. 5 years, you know, a measly 2%, but it's better than 0. All right, guys, now scrolling up, let's jump over to this profitability page real quick. And I want to look at this net income margin here. So as you can see, it's at about just under 10% actually, which is not too great. In some of the recent videos, we've looked at stocks like Microsoft that has a net income margin of over 20%. That one might have even had an income margin of over 30%. I don't remember. But we've looked at companies that have a much higher net income margin. So this 9.18% is not super crazy. It's not super high. But if we click this right here, it's going to pull up a little chart showing some of the net income margin history for Campbell Soup. And if we click over to the last 3 years here, we can see that it's actually improved over the last 3 years. So it's kind of interesting, as the stock price keeps continuing to go down, their net income margin continues to go up, or at least is net positive. So about this time 3 years ago, guys, the net income margin for this company was just under 4%. Well, now it's currently at 9.18%. So they've more than doubled their net income margin in the last 3 years. At one point, it was up to 20%. This was in November of last year. I don't know exactly why it's dropped down to about half of that, but you know, we're still net positive across the last 3 years, and it looks like the same is true across the last 5 years. So about this time 5 years ago, it was 7.07%, and then, you know, like we just talked about, right now it's 9.18%. So it's still higher, a couple percent higher. And I'll tell you what, guys, if nothing else, this is a good sign for the dividend, because the higher the net income margin of this company, the more that they're going to be able to contribute to the dividend. Which brings us to the next point. If we jump over to the dividend page for CPB and scroll down, we can see that Campbell Soup has a current dividend yield of 3.34%, which is not too shabby. A payout ratio that is right in the sweet spot, almost 51%, which means that they're contributing some money to the dividend and they're contributing some to continuing to grow and expand the company, which both are important, especially for a company that needs to turn some things around like Campbell Soup. They need to continue working on growing and expanding the company so they can get that revenue continuing to climb even more. Hopefully we'll see that net income margin climb even more, which should hopefully result in more dividend growth and more share price appreciation. Point being, this payout ratio is pretty good. Now, moving on to the 5-year growth rate, guys, it's actually pretty low, 3.19%, but to be fair, they've only been growing their dividend for the last 2 straight years. And if we scroll up to their dividend history, we can see that despite only 2 years of dividend growth, they actually have 32 years of consecutive dividend payments, which is important to me. I like to see that they're consistently paying out their dividends, especially for the last 32 years, which is longer than I've even been alive. To me, this indicates some sort of reliability and sustainability in keeping the dividend around. This is important, especially for people like us who rely on this for the cash flow. At any rate, guys, despite Campbell Soup Company being on the down and out as far as the share price goes, I mean, across the last 5-10 years, it's kind of wild that it's down so much in that span of time. I've mentioned this before in other videos when talking about Campbell Soup, but it's an iconic company. It's an iconic brand that's been around since before the 1900s. I like to put it up there as far as just its brand goes with companies like Pepsi and Coca-Cola, who are also classic American companies, and Campbell Soup is right up there with them. All right, guys, now the next stock we're going to be talking about today, stock 2 of 4, is going to be AT&T, ticker symbol T. I think this is going to be a great investment in the month of August and potentially the months following. Now, just looking at its performance over the last handful of years, in the last 5 years, AT&T has really taken a hit, much more than Campbell Soup. It's down over 35%. In the last year, it's really not doing so hot either, down 7.13%. In the last 6 months, it's down 3.18%. And in the last month, it took quite a hit, down about 2.7%. And moving on, let's jump over to this value page real quick. I want to talk about a couple key metrics. So the first of which being the forward PE ratio. So as you guys can see, the forward non-GAAP PE ratio is 8.68, which is extremely low. It's hard to find stocks with a PE ratio in the single digits. Sometimes that's not always a good thing, but it can indicate a very affordable stock, depending on what you believe the future of the company to be. Now, if you're pretty bullish on the company's future, you might look at this single-digit PE ratio and be stoked on it. However, you might, if you're somewhat bearish or somewhat unsure of how things are going to play out in the future, which nobody has a crystal ball. So if you're unsure, if you're not too optimistic about the company's future, you might look at this single-digit PE ratio and say, okay, there's probably something wrong here. Now, me personally, I'm bullish on AT&T, which we'll get to in just a moment. But scrolling down, I want to also look at the price to book. Now, an ideal price to book, a perfect price to book, is exactly 1.0. So the farther away you get from that perfect 1.0, the more expensive the company is compared to its book value. So a price to book of 1.2 is pretty close to being perfect, which indicates it's not too expensive. All right, guys, now scrolling up, let's jump over to the profitability page real quick. I want to look at the net income margin for AT&T. So as we can see right here, it is negative, which is not a good sign at all. It means that they're paying out more than they're taking in for net income. And if we look at this chart right here, we can see that this is very much trended downward for AT&T across the last 5 years, which is right in line with what we've seen with the share price of this company. So it's obvious just by looking at this and the other stuff that we've seen so far, AT&T needs to turn something around, okay? They've got to switch gears somehow, and they've got to change their tide a little bit and gain some momentum and start getting back on the right track. And actually, just a couple days ago, they put out their quarterly earnings for the second quarter of 2021. And if we take a look at some of those slides, you guys might get a better idea or some more insight as to why I think that AT&T is not too far gone, or why I think they could turn things around. So let's start by looking at some of the business priorities that they've listed in their earnings presentation. So the very first one is to grow subscriber relationships across the board. Now, AT&T operates in 2 segments, communications and their Warner Media segment. And AT&T here is stating that they're making it a priority to grow subscribers, or at least grow subscriber relationships, and also, I'm sure, the number of subscribers in both of those areas. Now, their second priority moving on is to become more effective and efficient in everything they do, as stated here, which awesome. I mean, that's a very general statement, I think. I mean, that's probably every business's goal. But let's move on to this third point here, deliberate capital allocation. This is actually a pretty big one. So invest in growth, okay, that's huge, increasing their subscribers, increasing their customers, and also improving those customer relationships in both segments. Investment in growth obviously very important. If you're going to continue to exist as a business, you need to continue to grow. Reduce debt. This is a big one for AT&T. This is a big issue that a lot of investors have with this company is their debt load. In addition to that, they've made some not too great acquisitions, DirecTV being a good example of that. And now they're selling off HBO Max, going to merge it with Discovery, which we'll talk more about in a minute. But that should also help dramatically reduce AT&T's debt. So overall, those sound like pretty good priorities, especially investing in their growth, reducing the debt. That's going to be important for making us shareholders happy for sure. And now let's move on, guys. Let's see how they performed in Q2 in both of their segments, communications and Warner Media. So moving on to communications, guys, looks like their revenue is up 10.4% for the quarter with 789,000 postpaid phone net adds and 174,000 prepaid phone net adds. It looks like they had a little bit more demand in 2020, second quarter 2020, because of the pandemic, but they're still holding strong even as we come out of that, which is a good sign. And also they've seen some solid AT&T fiber gains, and they expect to hit 1 million fiber net adds for a full year. Overall, guys, as you can see on the screen, AT&T thinks the revenue trend improvements will continue in the second half of 2021. So it looks like they'll continue to grow and expand on these results. Now, looking at their Warner Media segment, which won't be a permanent fixture in the company as the merger goes through, they saw some big subscription growth with HBO Max. It looks like Warner Media revenues were up about 31%, which is pretty substantial. And it looks like that's a total gain from this time last year of about $2.1 billion in revenue for this segment. And it looks like they're really expanding the subscribers they have for HBO Max, and they expect to hit 70 to 73 million global subscribers by the end of the year, which is about 3 to 6 more million than they currently have at this time. Now, that was a very rough explanation of their presentation. If you guys want to take a look at that, it's actually on the AT&T website. It's very quick to go through. You can just skim through it, read some of the stuff. It's kind of a good read, actually. But overall with AT&T, guys, I think the market is going to continue beating on AT&T, and I've said this before, but I think a lot of that has to do, at least recently, with the Discovery merger with HBO Max. And because of that, we may even see the price continue to go downwards into the near future. But overall, I see this being a good long-term move for AT&T. As they progress with the merger, they'll be able to focus specifically on their communication segment, which really is their bread and butter. And with that, as we just saw, they are still growing and expanding that segment in the business. And with that said, guys, let's briefly talk about AT&T's dividend real quick before moving on to the next stock. So we're on the dividend scorecard page here on Seeking Alpha. Scrolling down, we can see, let me maximize this, we can see that AT&T has a current dividend yield of 7.43%, a payout ratio of about 64.5%, a very low 5-year growth rate of 1.72%, and they've been growing their dividend actually for an impressive 37 consecutive years. Now, in regards to the dividend, I know we've been talking a lot about the merger with Discovery, and everyone who has covered AT&T, this is kind of what they're talking about. This 7.4% dividend will probably cease to exist when they spin off HBO Max with Discovery and complete that merger. Now, it's been reported before that AT&T expects to keep their dividend, keep paying the dividend, but they're probably going to cut it. And from what I've read, they could cut it up to about half. It could be half of what it is now, which even half of 7.4%, what is that, guys? That's 3.7%. So, it could be somewhere in the 3 to 4% range. It could even be a little bit higher. Time will tell. But just one thing to note with this company, the dividend will be cut at some point in the future if the merger goes through. All right, guys. Now, stock number 3 we're going to be talking about today is Intel, ticker symbol INTC. Now, Intel is a company in the technology sector that specializes in making and manufacturing microchips, stuff like that. It's actually one of the bigger companies in this space. And looking at their performance, in the last year, they're down 8.34%. In the last 6 months, they're down 1.24%, and in the last month, they're pretty stagnant, up only 0.16%. Now, Intel has actually been on the down and out for quite some time now, and I think the demand for their products has taken a little bit of a backseat to some of their competitors like AMD and NVIDIA. It doesn't help Intel's case that right now there's an industry-wide chip shortage. I'm sure you guys have read about this a little bit, but essentially this worldwide shortage of microchips has negatively affected all of the companies in this space. Now, how long the chip shortage will last is really anybody's guess, guys, but I was able to gain some good insight from reading this article I found on appleinsider.com. The article reads, "The global chip shortage will continue to worsen for the time being, according to Intel CEO Pat Gelsinger is how you pronounce it? I don't know. With the industry forecast to endure a worsening situation throughout the second half of 2021 before there's any real hope of recovery." Now, the shortage in semiconductor production affecting the supply of chips for electronic devices is thought to not quite reach its worst stage yet, the chief of Intel believes. Speaking in an interview, Gelsinger proposes the shortage could reach that point before the end of 2021. A lack of supply of semiconductors will reach its lowest point in the second half of the year before starting its road to recovery, said Gelsinger, according to Bloomberg. However, even that may not be enough for some chip production clients. I don't expect the chip industry is back to a healthy supply-demand situation until 2023, the Intel CEO said. For a variety of industries, I think it's still getting worse before it gets better. Now, jumping over to Seeking Alpha real quick, guys, I think the silver lining to all of this could be it keeps Intel at an affordable price, which makes it a good buying opportunity. Now, as we can see on the screen here, Intel has a forward PE ratio of 12.04, which is extremely low. Now, this makes it a good pickup right now, but one of the big questions surrounding Intel that a lot of investors have is if it can stay competitive with its competitors like AMD and Nvidia. Now, that's a question that I don't 100% know the answer to. I just know that Intel is a pretty affordable pickup right now, and I would be curious to know your guys' thoughts on this in the comments below. What do you guys think about Intel? Is it a good long-term hold, or do you think it's going to be hard for this company to keep up with its competitors? Leave me a comment below, let me know. All right, guys, now jumping over to this dividend page real quick, let's talk about that real quick. So as you can see here, Intel has a forward dividend yield of 2.48%, which is not too bad, especially as far as technology companies go. Has a pretty low payout ratio of just under 30%, which means they're really putting a lot of their extra funds towards the growth and expansion of the business, hopefully. It looks like their 5-year growth rate is 6.26%, which is manageable. Okay, it's not too high, it's not too low. And if we scroll up here, let's look at their dividend history. So you guys saw 7 years of consecutive growth on the previous screen, but it looks like Intel's been paying their dividend for the last 28 consecutive years, which to me indicates some sort of reliability with this dividend. We like to see them continuing to pay their dividends as time goes on, and 28 years is a long time. All right, guys, now the last stock we're going to be talking about today is Vici Properties, ticker symbol VICI. Now, I've talked about this in a previous video, and I actually found out about this company from watching one of Joseph Carlson's videos, who is probably one of my favorite investors to watch here on YouTube. I really enjoy checking out his videos, and I found out about this company through him. For those of you who have never heard of Vici before, it is a REIT, a real estate investment trust, that owns and focuses on experiential properties. All right, guys, now I have pulled up the homepage of their website right here, and you can see that just right here on the homepage, it says invest in the experience. And if we scroll down, it'll have a little blurb, a little bit of about them, and I'll just read that real quick. So Vici Properties is an experiential real estate investment trust that owns one of the largest portfolios of market-leading gaming, hospitality, and entertainment destinations, including the world-renowned Caesars Palace. And you guys know me. You know I love the Vegas. It's one of my favorite places. And Vegas has been just popping lately, okay? Tons of people are going to Las Vegas right now. In fact, tons of people are just traveling in general. And Vici Properties not only owns properties like Caesars Palace in Las Vegas, but they own a ton of other properties as well. So some of the other ones that they have, in addition to Caesars Palace, include Harrah's in Las Vegas, Jack Cincinnati, it looks like it's actually a Hard Rock, Cascada Golf Club in Boulder City, Harrah's in Lake Tahoe. So it looks like they own different hotel properties all across the country, guys. And if we jump over to Seeking Alpha, just as far as the performance goes, we can see that this has actually been on quite a run lately. So in the last year, Vici is up almost 42%. In the last 6 months, it's up almost 20%. And in the last month, it's down actually about 1%. And as the world has kind of started to open back up and get back to normal, the properties that Vici owns, especially as more people are traveling, the properties that Vici owns are continuing to bring in more revenue, which is obviously going to be good for this company who owns those buildings. Now, one of the concerns with Vici Properties is it seems like, I'm sure you guys have started reading about this in the news, there's some concerns coming out about this Delta variant. And if that turns out to be kind of a big deal, and we kind of, start becoming more restricted and locked down again, then this stock could actually take a little bit of a hit. If we end up in a position where travel becomes a little bit inhibited, then we may see this go down. But on the other hand, if the Delta variant turns out to not have a substantial effect on travel, we could see this stock continue to go back up. And despite its, 1 year growth of 42%, which is amazing, Vici Properties is still looking like a pretty affordable company to buy. So if we look over here, its price to funds from operation is 16.15, which is the number that we use for REITs. It's kind of symmetrical to the PE ratio. So if we're kind of using the same rules here as we do with the PE ratio, Vici Properties is still an affordable stock to buy, just based on this. All right, guys, now let's jump over and look at Vici's dividend real quick. So scrolling down here, they have a forward dividend yield of 4.18%, which is very nice. a payout ratio which is actually, I'm going to need to do some more research on this, but it looks low for a REIT. It's 67.5%. And from my understanding, REITs actually have to pay out 90% of their profits to us as shareholders. So typically you see this payout ratio a lot higher. Now, Vici Properties has only been growing their dividend for the last 3 years, so they don't have a 5-year growth rate listed here. At any rate, guys, this is the one that's still currently sitting on my watch list. I personally don't need to buy any more REITs right now, so it'll probably stay there. All right, my friends, and that pretty much wraps it up for today's video. So I hope you guys enjoyed watching this one, got some good information on the 4 stocks we talked about today. And with that said, I would be curious to know, what do you guys think of the 4 companies that we covered in this video? Do they look like potential buys to you? Are you holding off on them? Do you already own some of these? Let me know in the comments below. And if you are still here with me at the end of this video and have not done so already, please don't forget to leave a thumbs up before you click on to the next one. And if you're not sick of hearing from me yet and would be interested to see more videos from me, go ahead and hit that subscribe button as well. At this point, guys, I'm putting out videos twice a week, every Wednesday and every Sunday. So there's a lot of great content coming your way. At least I'm trying to put out a lot of great content for you guys. So that's about all I got for you guys. I will now get out of your hair. But thank you so much for watching this video. I really appreciate it. Hope you guys have a great day, and I will see you in the next one.